In December 2008, as the financial world collapsed and banks failed by the dozen, Bernard Lawrence Madoff sat in his Manhattan penthouse. The market was hemorrhaging trillions. Retirement accounts evaporated. Pensions vanished. But Madoff's fund had a different problem. His clients' money had never actually been invested at all. For 47 years, Madoff operated what would become the largest Ponzi scheme in history. $65 billion in fabricated gains, 17 to 20 billion in actual principal lost, over 4,900 individual investors systematically defrauded. The scheme worked not through complexity or obscurity, but through the opposite, the disarming simplicity of consistent returns that no market should reasonably generate. This is the story of Bernie Madoff. Bernard L. Madoff founded his investment firm in 1960, trading stocks from a small office in Manhattan. His operation grew methodically. By the 1980s, Madoff Securities had become a market maker for NASDAQ, handling enormous trade volumes. In 1990, Madoff himself assumed the chairmanship of NASDAQ. He was not a man operating in darkness. He was a regulatory fixture, establishment, trusted. The investment advisory division grew quietly alongside the market-making business. Madoff promised clients something the market rarely offers: consistency. 10 to 20% annual returns year after year, regardless of economic conditions. In bull markets and bear markets alike, the returns remain steady. This should have triggered alarm in every professional investor. Instead, it attracted them. The wealthy sought access. Country clubs buzzed with rumors of Madoff's strategy. The secretive split-strike conversion became legendary among the initiated. Madoff invested in blue-chip stocks, purchased put options to hedge downside, sold call options to finance the hedges. The explanation sounded plausible enough. Few clients examined the actual mechanics. Few asked to see trade confirmations. The auditor was a three-person firm operating from a strip mall in New Jersey. Reality was far simpler and far darker. There were no stock trades, no conversions, no hedges. Money came in from new clients. Money went out to existing clients as stated returns. The cash flowed into a single Chase Manhattan bank account. Madoff kept meticulous records, fabricating monthly statements with mathematical precision. Every transaction was invented. Every return was false. In May 1999, a Boston financial analyst named Harry Markopolos submitted a detailed warning to the Securities and Exchange Commission. Markopolos had attempted to reverse engineer Madoff's strategy and found it mathematically impossible. The consistent returns were a statistical impossibility. The split-strike conversion, as described, could not generate those numbers at that scale. The SEC filed the warning. Then they ignored it. Markopolos submitted additional complaints in 2000 and 2001. He warned again in 2005 with additional documentation. 5 separate SEC investigations were launched between 1992 and 2008. 5 times the regulators examined Madoff securities. 5 times they concluded nothing was wrong. Madoff himself was questioned. He provided explanations. He remained operational. The SEC's failures were not due to complexity or deception. They were due to indifference, to institutional momentum. Madoff was not operating in shadows. He was operating in the full light of regulatory oversight, and that oversight chose to see nothing. One SEC attorney later admitted that investigators believed Madoff was too well known and too prominent to be running a massive fraud. Reputation became immunity. Decades passed. Madoff moved deeper into his 70s. His scheme continued expanding, swallowing the savings of philanthropies, pension funds, nonprofits, and individual retirees. His family was bound into the operation. His sons, Mark and Andrew, worked at the firm. His wife, Ruth, benefited from the lifestyle. The lie metastasized into complete identity. Then came September 2008. Lehman Brothers collapsed. Credit markets froze. The world's financial system appeared on the edge of disintegration. Clients panicked. In a normal market downturn, they would have withdrawn modest amounts. But in the crisis that followed, everyone wanted their money simultaneously. Madoff could not pay them. The account that held billions in actual principal had been depleted. There were no reserves. There was no strategy. There was only the accelerating realization that mathematics would eventually force the truth into the light. On December 10, 2008, Madoff called his sons into his office. Mark and Andrew arrived expecting a routine business conversation. Instead, their father told them the truth. The investment operation, he said, was one big lie. The confession was not an act of conscience. It was an act of arithmetic. The scheme had become insolvent. Madoff was attempting to raise $6 billion to meet pending withdrawals. He could not raise it. The collapse was mathematically certain. His sons did not immediately call law enforcement. They called a lawyer. The lawyer called the SEC. The FBI was contacted. Federal agents arrested Bernard Madoff at his penthouse on December 11, 2008. He was 80 years old. Agents found $17 million in cash stored in his office, earmarked for family members and associates. Madoff pleaded guilty to 11 federal felonies. No trial was necessary. The evidence was too complete. The victim list included universities, foundations, and employees of his own firm. Steven Spielberg's foundation had invested with Madoff. The Elie Wiesel Foundation lost $15 million in direct investments and an additional $12 million in personal assets. Actor Kevin Bacon and his wife lost money. Thousands of individual retirees lost their life savings. Some had invested their entire net worth based on Madoff's promise of stability in their final years. Judge Denny Chin imposed the sentence on June 29, 2009. 150 years in federal prison. At Madoff's age, it was a death sentence wrapped in bureaucratic language. There would be no appeal that mattered. There would be no negotiation. The size of the theft and the scale of the deception rendered mercy impossible. Prison did not bring closure. It accelerated the collapse of everything around him. Frank D. Pasquale, the lieutenant who had managed the daily mechanics of the scheme for decades, died of cancer before sentencing. He took operational knowledge to his grave. Mark Madoff's existence became unbearable. He had believed in his father's investment strategy. He had recommended the fund to acquaintances. He had worked at the firm believing it was legitimate. On December 11, 2010, exactly 2 years after his father's arrest, Mark hanged himself in his Manhattan apartment. He was 46 years old. Andrew Madoff survived longer, but not by much. He died of cancer on September 3, 2014, at age 48. His childhood and career had been built on his father's lie. His death spared him the further slow erosion of watching his father die in prison, while the legal system attempted to parse who was complicit and who was merely negligent. Madoff himself lived longer than expected in federal custody. Irving Picard, the bankruptcy trustee, spent years recovering assets from people who had withdrawn profits during the scheme's final years. Approximately $15.38 billion was recovered. Victims received 75 cents on the dollar. It was the largest recovery in Ponzi scheme history, which meant it was still catastrophic for those who lost everything. Bernie Madoff died on April 14, 2021, age 82, at Federal Medical Center Butner in North Carolina. He had served 13 years of his 150-year sentence. His death passed with minimal acknowledgement. The financial world had moved forward. New scandals had surfaced. New frauds had been discovered. The institutional failures that allowed Madoff to operate remained largely unaddressed. The Ponzi scheme survived for 58 years because it exploited something deeper than greed. It exploited the human need for certainty. Madoff offered returns that defied mathematics because investors desperately wanted to believe such returns were possible. Regulators overlooked the mathematics because Madoff's prominence suggested competence. Banks accepted transfers that revealed the fabrication because they did not think to ask questions. The system failed not because it was infiltrated by an alien fraud, but because the fraud was fully integrated into the logic of the system itself. The victims, scattered across decades and continents, never recovered what they lost. The families, broken by suicide and disease, never reunited. The truth, when it finally arrived, came too late for everyone, except Madoff himself, who did not want it to arrive at all.